boom, right? And then last but not least, here's the required. So they say critically review, right? So once I saw this critically review, I was like, well, I was not critically reviewing the information, so I had to go back and now critically review it. And I literally, when I decided, I literally went back and I opened my standard for each section. I'm like, oh, this is the IFRS 9 section. Let me quickly read through that. Oh, this is the ICE 12 section. Let me quickly read through this. Oh, this is an impairment. Oh, I kind of already know what needs to be discussed in impairment, but all other things I'm not sure. Let me quickly go to that section. Draft the financial statements, position, and the notes provided for the apparent inaccuracies, inconsistencies, errors in application, and maybe there's just outright non-compliance with IFRS. So they're basically saying what is wrong with the scenario. You tell me and use IFRS as guidance. Limit your discussion to the issues for which there's evidence, right? So this means that if they haven't discussed or even brought up something, but you know should be applicable, you can't really go deep down that rabbit hole. Ignore comparatives. Detailed disclosure requirements or sample disclosures are not required. So you don't need to go into full detail saying this is the amount, step 1, step 2, or disclosure 12A, disclosure 12B. And then you don't have to, because you know sometimes you get those questions that say state what's wrong and then state the correction. They just want you to tell us what is wrong, so you don't need to give us a sample disclosure. And then they also said no calculations are required. So that's 42 marks. 2 of those marks is just logical argument, clarity, and expression. So for me, what that means is have your things set up in headings, right? Don't start talking about IFRS 9 in one paragraph, then move over to the goodwill, and then 2 pages later you start talking about IFRS 9 again because you forgot. You want to group all your things, make it make sense. Either you're going to start with all your assets and then all your specific assets grouped together, or you're going to start with an impairment and all your impairment discussions grouped together. That leads to logical argument, leads to clarity and of expression. You don't want to be sounding. And for me, it's not always easy to, answer your question or speak in the way that the solution looks like, but headings go a long way for me. All right, so that's how you would that's what I'm thinking, and then calculation is cool. So these marks I need to bank. Now when you're looking at these 40 marks, right? So how I'm thinking in terms of this planning and this exam technique with these 40 marks, what I'm telling myself is there's 40 marks, right? Again, it was ITC, so I don't need to know about what was my average previously, what I need to make sure, what do I need to do to make sure I get 60, so I end off with 50. It's literally on this day, I need to get 50. And what do I need to do to make sure I get that 50? So if it's 42 marks, or it's 40 marks, which is actually saying what's right and what's wrong, I'm thinking to myself that 50, I need to get 20 of the things that I put down correct, and then I'm sorted, right? But I'm not just gonna write 220, because for me, in my experience, of the things that I write, 50% of whatever I put down is most likely gonna be correct. It might be higher for some, it might be a little bit lower for some. So to hedge my bets, I'm not gonna write 20, because if I write 20, if I get full 20, all 20 correct, then I've passed that specific paper. But what are the chances of me getting that 20? What are the chances of everything that I write, I get 100% correct? That's going to be, for me, I thought it's going to be really low because I didn't even done a question like this, right? But I'm thinking and I'm planning what's the best way to answer this question, because I need to answer this question. It's a 42 marker. I need to pass this paper. So everything that I write, I'm going to get 50%. So if I write 20 things, right, that means I'm only going to get 10 of those things right. So of the things that I've wrote, I've gotten 50% correct, but that I don't pass the question, right? Because I need to get 20 out of 40, but I've only written 20 things and I'm only going to get 10 right. So I'm going to get 10 out of 40, right? So what I wrote down, I've passed that, but to pass the question, it's a problem. So what I'm going to do is I'm going to write more than the mark allocation. And like in these exam sort of scenarios with the discussion, it's usually a sentence or some point is a mark. So which means I need to write basically 40 marks or 40 points, right? And of the 40 things that I write down, 50% of those things are going to be correct, maybe more, maybe less. So then I'll pass the question if I write up to 40. And then because of that, then I even hedge a bit more. So I'm like, okay, I'm being hopeful if I get 50% of those things right. So I might even try and push for 42, 45 lines of information. And if I get 45 and I get 50% of that 45, then I'm going to get 22, 23 out of what I wrote. Then I'm going to get 23 out of 40. So then I've even gotten more than the 40%, right? So when it comes to writing, when it comes to discussion, especially when it's like, even with substantive procedures, if it's a 10 marker, I'm going to try and write up to 20 things. Because then if I get half of the 20 things that I've written down, I've gotten 100% of the marks for this question. I've banked substantive procedures. Similarly with like a math question. So the session that we had yesterday was discussing business risks. It was discussing, what are the business risks that this company would have been experiencing. It was, I think, 14 marks. I would aim to write 20. I would write 20 points. Because then if I get half of those points right, I get 10 out of 14. So I've gotten 50% of what I've written down, but then I've smashed the question, right? So because I also understand that, with a discussion question, you don't really know how much to write, how little to write. So I just use the mark allocation as these are sentences. And when it's a discussion question, it doesn't need to be perfectly written like it was an essay. This is my opening paragraph. This is my body. This is my conclusion. All the paragraphs must flow with furthermore and even so and although. It doesn't necessarily have to be that way. When it's a discussion question, all they're saying is answer to me in written format. Don't just give me a bullet point with a calculation. You can still use bullet points though. You use a bullet point, but say a full sentence in that bullet point. Use another bullet point, say a full sentence. If you're moving to another point or another category, leave a line and then write another bullet point. Also, like, because you guys are going to be writing at the venue, don't be shy. Like, I would write a point, leave a space, then write another point, leave a space. And then, of course, the spaces might confuse the marker, but then all of my points are going to be in headings. So I'm discussing impairment now, point, space, point, space, point, space. The reason why I'm leaving the spaces is just in case I'm 20 minutes into my writing, I'm discussing something about IFRS 9, which reminds me something about goodwill, so I can come back and I have space in between to write it. So I don't lose the clear and logical, mark, because those, I need to bank those every day of the week. So yeah, and in terms of planning with the exam technique, so I would look at those discussion questions. I would think, okay, what actually should I be writing? Where am I going with this? So then I'd have my headings, and if it's a 42 marker, I'm going to be writing for quite a bit of time, and some sections are going to be more than others. So I wouldn't even be shy, and I'd write IFRS 9 and I'd leave a page. Then I'd write impairment and I'd leave a page. Then I'd write maybe goodwill and I'd leave maybe half a page, because I'm like, I've told myself I don't really know too much about that. I write in inventory and then I'd leave a page, and then lay out my marks, because then I've left out a page. Doesn't necessarily mean I need to use the whole page, but in case I need to come back, I know. Plus also, because I've laid out all my headings in my exam, I'm not gonna go spend 30 minutes on trying to say everything about IFRS 9, because I've already put down in my head that there's other pages that I need to finish. So then it also, I guess, helps with the time management. I felt like it used to help with the time management. So I'm not going to go too detailed in IFRS 9, because I still need to get to goodwill. I still need to get to impairments. I still need to get to inventory. I still need to get to liabilities. So the planning is very important. And then, of course, with my headings and my planning, I know that now I'm thinking to myself, okay, I've got maybe 8 headings. So if I got 8 headings because there were 8 different line items in this extract, and I'm going to work on 8 headings. So I'm going to, how do I divide this 8 headings into the marks that I need to write about? So therefore I need to basically write 5 points, more or less 5 points for each of the headings that I have. Now what I've done is I've taken that 40 marks and I've broken them down into bite-sized, easily manageable pieces. Because I'm sure you've heard the saying, like, how do you eat an elephant, right? It's like one bite or one piece at a time. So it's 40 marks, looks daunting, looks a lot, but in my scenario, there's a lot of things I need to discuss. So I've got 8 headings: goodwill, investments in associates, IFRS 9, inventory, cash and cash equivalents, whatever. And those are 8 headings. I'm going to make sure that I've got 5 points for each of those headings, right? And then those 5 points of each of those headings, if I have 5 for each of the headings, if I have more, that's better. But if I have 5, at least 5 for each of those headings, I know I've hit the 40 marks. And if I've hit the 40, not the 40 marks, but if I've hit the 40 points, I'm sure half of those points are going to be correct. It's not going to be, I don't know where they're going to come from. That's the marker that needs to decide, but I'll see. And when I see which ones are right and which ones are wrong, I mean, when I finish all my 40 points, the marks are going to come from everywhere, but at least I've given myself enough of an opportunity to pass this question because I've given them 40 points. If I only give them 20 points, then I must have really been that good in that section. But also, if I'm that good in that section, I could probably write more. So writing only 20 for 40 marker to pass the question is not, necessarily going to be working in my favor. So you want to push yourself with a discussion to write as many points as possible. Sometimes you get to a point, and why I say 50% of what I write down is going to be correct is because after you've written like 20 and you're probably going to be tired, you're probably going to start making up things, start waffling, right? And if you're not practicing and good at that, you maybe write 10 things and then you start waffling the next 10 things, but you actually need to, write 40 points just to hedge your bets. So you definitely want to get into, the habit of practicing your reading, your writing time and writing more than possible. Before we go to the solutions, any questions there from anyone? No? Good. Right, so the solution. So general comment, right? So they say that there are no note disclosures for specific material lines, for example, property, plant and equipment, bond liability. So property, plant and equipment, this would be probably like the PPE recon, the bond liability, right? So if you were writing, you would want to say something like this, right? And then look, right? You can see the discussion question, but they're not starting with an intro paragraph, long and lengthy. It's not like the reading time. It's bullet points, 1, 1.1, 2. Then they've said, since these are regarded as being material, given the size of the nature of these balances, specific detailed disclosures are required in terms of IAS 16 and IFRS 7, right? So the material balances, IFRS 7 and IAS 16 would be useful. So now you've done this question, you're marking it, right? What you don't want to do is say, oh, I didn't get this, I didn't get that. You want to say, yes, I didn't get this, but now what have I learned? So now I know that when it comes to IAS 16 and IFRS 7, material balances must have specific disclosure. In other words, the next time I get a question and they're asking me about disclosure and it's something about IAS 16, if it is material, there must be specified disclosure. If they're asking me about financial instruments and it's material, there must be IFRS 7. Right? So you're using this scenario to see how much you know, but also to teach you what mistakes not to make the next time you go through this. You go through a question that has disclosure. Again, very niche. I'm saying the next time I have disclosure, which might never really happen in the next, it might not happen, but in case it does, I'm thinking in the right aspect. And don't just limit it to IAS 16 and IFRS 7. Maybe there's value in saying that any material balances on the balance sheet must have specific detailed disclosure, which means that every section I need to look at what are the specific detailed disclosure for IAS 2, for IFRS 2, for IFRS 16, for IAS 40, for IAS 32, so on and so forth. Right. Cool. And then they say the statement of financial position should include all general features as required by IAS 1. So when it comes to disclosure, IAS 1 is a good place to start because IAS 1 and IAS 1 tells you what a financial statement needs to look like, what an income statement needs to look like, what a statement of changes of equity needs to look like, what should be in current assets, what should be in non-current assets, what should be in current liabilities, what should be in non-current liabilities. The illustrative examples gives you an extract of what a balance sheet looks like, what a PPE recon looks like, what a statement of changes in equity looks like. So that's also good practice to just have. And then there they're saying things like the name of the entity and the reporting date. Jamio Ltd for year ended 31 December. I don't know if you know, but when they ask you for extracts to your financial statements, there are usually marks for having this long name written out at the top. That's like the first mark that you can actually get. If it's an extract, you'll say extract of blah, 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 statement of financial positions as at. You get penalized if you say as at, as opposed to year ended when you're talking about your statement of comprehensive income. These are like small niggly things that might not seem too important, but I'm of the opinion that every mark I lose, and if it's an easy mark that I must get, I'm never making that mistake again, because then I'm getting that mark for barely even thinking. If it's there on the plate for me, I'm definitely taking it home with me. Where I want to lose my marks is the things that are very difficult, that I didn't even really have time to go over in my notes, or it was never in my notes and was only going to be a question that I was going to really get if I fully understood the whole landscape of accounting, or the whole landscape of auditing, or the whole landscape of a financial institution. But most of the times in your exams, there's 40 to 60% of the marks that are low-hanging fruits. If you've gone through the works, you understand the basics, the fundamentals, you'll get the marks. The other 40% are the ones that separate, I guess, the ones that really understand the content, the ones that are always getting the 70s, the 80s, and the 90% for the section, because that's where you're applying the knowledge and you're really understanding how it all fits together. But to pass a question, you don't need to be at that level. You just need to be getting all the low-hanging fruits, identifying all the easy marks, knowing the fundamentals, knowing the basics. Cool. Right. But with these sections, like the general comments, in my mind, I'm like, I know about this, but I don't really know enough to say it. So maybe I wouldn't have gotten these marks. So then they go to the impairment testing, and they say with the impairment testing, they discuss things like the forecast period of 7 years is a problem. They explaining the next point basically expands on what that point was. It says that probably going to be over the remaining useful life, which makes sense. Remaining useful life. If the remaining useful life is longer than 7 years, then we should do it longer than 7 years, because we want to get all the value from this cash generating unit. So why would you limit it? If the remaining useful life is 3 years, how would you go to 7 years? Because this useful life, this cash generating unit will be gone. It says that if remaining useful life of an asset cash generating unit exceeds 5 years, cash flow projections based on financial budgets or forecasts shall cover a maximum period of 5 years unless a longer period can be justified. So in your standard, it will tell you this, right? But now when you went through this question, maybe you didn't go through your standard in that much detail. But now I know when it comes to impairment testing and it comes to using the income method to calculate the cash generating unit, this is a very good summary of things that I must always remember to do when I'm doing an accounting impairment test for a CGU. And if I'm using maybe the income method, maximum 5 year period unless justified. It's basically saying the same point but in more detail. Management may only use cash flow projections based on budgets or forecasts over a period longer than 5 years if it is confident that these projections are reliable and can demonstrate its ability based on past experience to forecast cash flows accurately over the long term. Right? Quite a long worded sentence. This is in your standard, right? But now I have a summary of what's in my standard. They've again going to speak even more about 5 years. They saying that they use the group WACC as a discount rate. That's a problem. Why is it a problem? The discount rate should be pre-tax. We know that WACC is after tax, right? I know specifically when it comes to doing your impairment and your discounting in IFRS 13, you use pre-tax, not after tax. The discount rate should reflect risk specific to assets. So you can't just use a group. It's a CGU. So we would have to use a discount rate for each asset. They explain this here. It's not good to use a uniform rate. There are two business lines with different rates. So again, speaking in more detail, why you can't just use one uniform rate. So I'm reading this and I'm thinking to myself, okay, when I'm doing an impairment test when I'm doing an impairment test, I must remember that of course I need to use a different rate because different risks, different businesses. That's very important. They've explained that the discount rate has decreased. They say that given the risk of the business has increasing and downgrading the credit ratings by Moody's, one would expect the discount rate to increase. Yeah, that makes sense. A lower discount rate means less risk. A higher discount rate means higher risk. We know that this business has increase in risk, so we're expecting the discount rate to increase. No impairment test was performed. So this is like the easy mark. This is a mark will probably be the first thing that I would put down, because how can we not have an impairment test when we know the business hasn't been doing well? How can we not impair goodwill annually? And then you basically expanding on why you would do it annually. This is what the standard says when it comes to impairment on goodwill. And they've even said there's several indicators of impairment present, so why haven't you done this? So this could have been, 4 easy marks that you would have gotten just for this section. All of the other ones could have been tricky, but for the impairment test, the last few ones would have probably been the easy ones that you would have gotten. 17 available things you could have said for impairment, but for me, I think these four would have probably been like the easiest thing that we would have jumped out to me. So financial instruments when it comes to accounting policies. So when it comes to accounting policies for a specific section, you're looking at like initial recognition, initial measurement, what it's saying there, and then that derives your accounting policies. So here they're saying that there's irrelevant or boilerplate disclosure. Like there's no apparent evidence of debt to equity instruments at fair value through other comprehensive income. So basically why we're including this. They're saying that there's too much disclosure for debt instruments because there's no debt instruments. It's a manufacturing entity. Insufficient disclosure on trade and other receivables like expected credit losses. And we know that they had problem collecting cash this year. They said that it's a significant balance. Remember the general point that we saw at the top, significant balances should have more disclosure, and they've said that customer collections have been a problem, so we would expect that we should have some more disclosure. If they're not gonna, I guess, create an expected credit loss for customer collections, they need to explain why they're not gonna basically have create the expected credit loss, because maybe they're very, very confident, or maybe they've sold that debt to someone else and they know they're going to get the money, or maybe they've received promises, but we need to receive disclosure around that. Okay, cool. Now this section, I'm not going to go into too much detail, but I would use this section as a example of what are the rules that I need to have. What are the rules that I need to have for unlisted investments? Unlisted investments classification at level 2, not going to be good. Observable inputs, that's why we're going to have it at level 2. They explain why you should have it at level 3. There's not adequate disclosure for IFRS 13. So now that tells me unlisted investments should have IFRS 13 disclosure. It's unlikely that the fair value will stay the same. That makes sense, right? Usually the fair value will change because the PE valuation is based on earnings, and earnings change year on year. Even a R1 change in earnings is most likely going to change the PE valuation. And then they say that it's held for trading purposes. It has not recently bought or sold. It is an investment in a private company. There is no active market for it. And then they said based on the accounting policy, it may be therefore more appropriate to have a fair value through other comprehensive income. Yeah, because you usually have something under fair value through profit and loss if you're holding it basically for trading. You have the view that it's going to increase or decrease, and if you have the view that it's going to increase or decrease and you're going to sell it when it's at a higher amount, then you want to show that it's moving. If it's not moving, or you haven't been selling it or buying more over time, then you just include it in the other comprehensive income, because you're not really showing any fair value movements, or you don't really want that fair value movement to impact your income statement. Right, deferred tax. This might be quite a useful one. Are there any questions at the moment? No, none, so not at the moment. Cool. So deferred tax, right? So now this is going to be a good list again of like the deferred tax disclosures that we need. Now IS 12 to read on its own is not like the easiest, not the greatest. And then to also understand, if you can't really read what the sort of like assets and liabilities like would impact IS 12, I found it difficult to understand the sort of disclosure that would relate to IS 12. So this summary would be, I think, quite a good summary to help with the sort of disclosure I should be looking out for when they talk a lot about deferred tax, when they talk a lot about deferred tax assets and deferred tax liabilities. So off the bat, they say deferred tax assets are offset against deferred tax liabilities in the group, right? Problem. Deferred tax assets and liabilities should only be offset when the entity has a legally enforceable right to set off current assets against current liabilities, and the deferred tax assets and liabilities relate to income tax levied by the same tax authority and the same taxable entity. This wasn't the case because we know we had different subsidiaries, we know we had different subsidiaries in different countries, so we know there's no tax authorities are different there. And then the assessed losses mostly relate to losses in one of the subsidiaries in the plastic business. Therefore, it's unlikely that the deferred tax and the deferred tax liability relate to the same taxable entity. So explaining, we're saying that this is the principle, this is the application, right? The principle says you can't do this. Now the question is, oh, does it apply to us? Well, it applies to us here because it's one plastic business, but we know we do paper and plastic, so chances are it's not. And then the other deferred tax assets and liabilities are going to be to the paper, but they're not going to be for the same taxable entity, and they're not going to definitely be for the same reporting tax authorities, as I mentioned here in 14.3. And then with deferred tax assets, we might not be able to recognize the deferred tax assets because a deferred tax asset can only be recognized to the extent that it's probable for future taxable profits. So that's the principle. And the entity has suffered operating losses in the current and prior years, and this may indicate future taxable profits are not likely. Right. So that's the principle. And now, because we've seen in the scenario that they've been suffering tax losses over time, there might not be an indicator that we're going to get into a position where we make taxable profit to even use the assessed losses, and then SARS is not gonna, or the tax authorities are not gonna allow you to basically offset, and then therefore from an accounting perspective we can't offset it. And then as one is specifically told which disclosures are provided with regard to deferred tax asset, it appears that there is insufficient. So yeah, the standard says what you should do for deferred tax assets. They haven't told us this. This is like any amounts of tax losses which no deferred tax asset has been recognized, which is most likely, and then the amount and nature of evidence supporting the recognition. So why do you basically you have to disclose why do you think you can recognize the deferred tax asset by showing or telling us that you have indicators that you're going to make more, you're going to make some profits in the future that you can offset this against. Okay, and then so loans to associates. So if you never really knew what to do with loans to associates and how it impacts your financial statements, here's a good summary of it. 9 points. Oh yeah, and then just to quickly recap, so the easy marks I think in this section would have been, you know, classification. So these three I think would be good points. Adequacy of disclosure. So if you open up IFRS 13, you would have seen have they shown enough. So that's maybe a good one to see. I think for me this jumped out to me. Why isn't it moving over time when it's basically estimates and it's based on PE? So this should be an easy one. This one would have been maybe more difficult to, these last three should have been, might have been more difficult. But in terms of this 10, there's, I guess 1, 2, 3, 4, 5, I'd say are like the easy low hanging fruits that you should be getting, maybe 6. And then the last 4, you know, so I guess my theory is kind of applicable. 6 out of the 10 are like the easy low hanging fruits, especially if you understand IFRS 13. And this one is really, you know, really going above and beyond and understanding IFRS 13 plus well, not IFRS 13, IFRS 9, and what it means to be held at half for trading, and what it means to be held at fair value through other comprehensive income. If you do the same exercise here for the deferred tax assets, yes, I think this is the easy mark. If you know that what the offsetting rules are, this is another easy mark. If you know why you can't offset, this is another easy mark. If you understand the principle, always important to apply. This is another easy mark because it's again still speaking towards the offsetting rule, so that's 4. And then deferred tax asset. For me, as a rule of thumb, whenever there's a deferred tax asset, you must think, can I recognize it? So they've mentioned deferred tax asset on the financial statement. So, but now you need to consider whether it's appropriate. And because they haven't explained this, these should be easy marks. And then these ones should be easy mark if you have actually opened up your IAS 12 and looked at what are the disclosure requirements for IAS 12. You would have picked up that deferred tax asset is a disclosure requirement, and you would have seen what are the disclosure requirements for IAS 12. So therefore, these I think 2 marks should also be quite fairly straightforward. And I often do this with all questions that I do. Look at the solution and try and point out, okay, was this a disaster of a question that I would never have passed? And I never really like to think that way, because I think there's always like a lot of easy marks, a lot of possible marks to get out of, especially the sort of marks that look like they more or less just basically taking it out of the standard and putting it into the solution. Well, if they're taking it out of the standard and putting it into the solution, then I have the standard with me when I write my exams. So I should be able to remember to take it out of the standard, put it into the solution, and then extra step is to apply. Okay, and then so accounting for the loan at historical rate is incorrect. The loan should be recognized as fair value in accordance with IFRS 9. The initial fair value of the instrument should be determined by the discount rate. However, since the loan is payable on demand, there is no period over which the future cash flows can be discounted. Therefore, the fair value may be equal to its historical cost and initial measurement. So they're saying that the amount can be recognized, the amount that the measurement can be historical cost, but the principle or the way you should measure it should be at fair value. But if you can't calculate the fair value, you can keep it at historical cost. And then they say the classification of the loan as non-current asset is potentially incorrect. Repayable on demand, as such, the entity should assess and disclose in its assumption on whether it will demand payment. Okay, that kind of makes sense, but this would be quite a tricky one to get. And the classification of a loan as non-current asset in the statement of financial position does not agree with the disclosure in the maturity analysis. So yeah, because they've put it on a non-current asset in terms of the balance sheet, but if you look at the maturity analysis, I think they put it at payable in like 30 days or something. Oh, and then related party disclosure. So whenever there's group companies, there's always related party disclosure, and then they explain to you why the related party disclosure is there. So this one is probably as a whole very tricky, but now we know, so we won't forget. Yeah, financial risk disclosure, quite a few marks. This was fairly new, not very much covered when I was studying, so I would have put this also in the category of difficult to get. But what's important here is they've said that they only have liquidity risk, but they have other risk as well, because if you open up I think it's IFRS 7, then it tells you what other risks are applicable to a company, and we can see foreign operations, currency risk, interest rates on the loans, price risk, unlisted entities, and credit risk, problematic customers. So if we understood IFRS 7, these would have been easy marks that we could have been getting, right? So for this bucket of financial risk, probably easy marks that we should get there. IFRS 17 requires maturity analysis, but amounts included in the maturity analysis should be undiscounted values. Yeah, that makes sense. But yeah, I admit IFRS 7 is a section that I don't know too much about, but I think it's maybe something to consider, and maybe have a quick read through what IFRS 7 says about the disclosure requirements. Cool. Segmental reporting, I think, yeah, that would have been like very yeah, easy marks that you should be getting there. Yeah, so they're saying that this seems incorrect, that they only have one segment due to being a listed entity, an entity within the scope of IFRS, and therefore segment report needs to be presented. So if you open up IFRS 8, you would have seen this. These appears to be more than one operating segment, right? So plastic and paper business, right? That's the principle, and they apply the earns revenues and incurs expenses, and then it's likely that discrete financial information is available. So you're allowed to not maybe split it between operating segments if you don't have that much information, but we would assume that it being a listed company, they have this detailed information. And then they've just explained like the quantitative thresholds on how to do segmental reporting, and then they explain further that they should not be aggregated. So now we know when we're doing segmental reporting, these are the things that we should apply to make sure if we ask the question about segmental reporting, these are kind of the things that should drive our answer of it. If we're checking whether segmental reporting has been done correctly, these are the rules that we want to follow. Cool. And then contingent liabilities, see like 8 marks on just contingent liabilities. They said that the classification of the settlement as a contingent liability, possibly incorrect, right? I agree with that. This seems to be an adjusting event after the reporting date, since it provides evidence of conditions that existed at the reporting date, the alleged price collusion, yeah, which already took place in the previous year, and the investigation by the Competition and Commission Act. So we know that that's giving us indication that maybe it shouldn't be after the reporting date, but it should be in the reporting date. Yeah, a provision should have, yeah, so they've said that the provision should have been recognized because we have a present obligation. We know that the settlement agreements after a year are probable past event, and the amount is reliably measurable at 20 million. Cool. And then so they basically applied the provisions, recognition and measurement criteria, because they've stated a contingent liability. Doesn't really seem like it's working as a contingent liability, so we should maybe do provision, but we're only going to be able to prove that a provision must be recognized if we go through the whole reporting criteria. However, I guess you would have gotten a mark if you just said provision should have been recognized, but it would be worthwhile to explain why, and then going through a definition. And then again, this is also like a good example. If you get a quick 4, 5 to 6 mark question on should there be a provision or what should be the accounting treatment of an event after reporting date, this is the process that you would have to follow. Right, and then remembering at the beginning, they said that their significant judgments and source of estimates was only due to impairment, but now this section actually focuses and gives us a lot of detail around what other judgments of and significant estimates are applicable in this scenario, and then it explains to you what's useful about this is for this section of significant judgment and estimates, it gives you like the type of asset balances and the type of transactions that actually do have significant judgment and estimates and would be included if you did disclosure around significant judgment and impairments. So things like residual values, things like provisions for expected credit losses, things like deferred tax asset, because it's an estimate. If we're saying that we can only recognize a deferred tax asset if we're going to have future taxable income, we don't know if you're going to have future taxable income. So we're guessing. And if we're guessing, right, that's an estimate. So therefore it must be included in this section. And there was quite a few marks around there. So that was mainly the question. Look, available 95 marks, right? Maximum 40 marks. You only needed to get 20 out of this 95 marks to pass this question. Even if you got the full 40 marks, you weren't even coming close to half, or you were close to half of the available marks. So these questions, there's a lot of things that could have been said, but they limited to 40 marks. So for me, I often felt like when I'm doing a discussion question, it's like, how do I think this way? What if what I thought wasn't going to be applicable, right? And now they're only limiting me to 40 things. How am I going to be sure that 20 of the things that I'm actually thinking are going to be worth marks to receive? But now we saw that there were 95 available marks. Like, that means there was a lot of things that you could have thought that was probably going to be on the right track using your knowledge that you would have gotten over your studies. So that's comforting to me, because I don't need to be very concentrated and very limited to how they are always thinking. Right? My interpretation of how things are going would have been applicable if I understand the basics and understand the fundamentals, and what I would have thought of on the day with the basics and the fundamentals. There's a good chance that it would have been applicable to pass the question, because there was 95 available marks. Cool.